Welcome back. I hope you all had a restful break and also maybe a productive break to some degree, at least a little of both, maybe. Hopefully, you've been thinking about your security analysis project and maybe you've made a little headway on that. Before we get going too much, over the semester, folks have decided it's easier to leave cameras off. Let me just strongly encourage cameras, please. It's helpful just from the psychological perspective. So please, if you can possibly leave your camera on, I'd appreciate it. And it's also, gives me a little easier feedback if I just see heads nodding or that sort of thing. So I appreciate that. And let's see, the other thing I wanted to talk about was, I don't know if you noticed, but I changed the deadline for the second deliverable on the security analysis. It was on the 12th, and I've changed that to the 19th to give you guys a little extra time here. This part of it is actually probably the most time consuming and the part that I want you to spend probably the most time on. So I didn't want to rush it. That only leaves us another week to finalize things, but the second deliverable is going to give you the vast majority of the understanding about the security itself in the marketplace and so forth. So let me switch over to this. So here's the assignment, and one of the things that we're going to be doing is creating this pro forma financial statement, and that's something I wanted to get a sense from you all. The chapter, I believe it was chapter 19 in the textbook, talks about that, but I'm not sure where you all are at with your spreadsheet skills. So what I was considering, something that might be most efficacious for both of us, rather than me meeting with one team at a time and showing you kind of the same thing over again with each team, I was considering doing, if we could set up a kind of a group time, and we could walk through some of the details of creating this spreadsheet as I envision it. So maybe it's one team, maybe it's two of you, whoever is working on that part of it. So, usually that would be the person with the best spreadsheet skills would be the person that I would expect to see working on that. So what do you all think about that? Is that an idea that might be helpful, or would we just be wasting time? Matt, you're saying yeah? Say Noah, okay, Kabir. What sort of time frame works for you all? I mean, are we talking about like maybe, I don't know, sometime I'm happy to do it over the weekend if that's easier scheduling wise. We could do something, say, on this Saturday afternoon. And remember, I don't want to wait till the 18th to help you out with this, because it's going to take you some time to actually incorporate this. But if we can do it sometime before, let's see, what's the calendar look like here? We're on the 8th. We've got 11 more days. So that's a week from this coming Monday is the 19th. Any days in particular? Anybody want to throw out a day, an evening? I know some of you are athletes, so I don't want to interrupt that sort of thing. That's why I'm suggesting maybe a weekend. This weekend, this Sunday afternoon, Saturday afternoon.
I think Saturday afternoon would be good.
Okay, all right.
I don't know what anybody else thinks, but
Yeah,
is that something?
For me personally, I have track meets all day Saturday, so Sunday, early afternoon to night would be better.
Okay, all right. That work out all right with others too? Sunday would be better than a Saturday?
I would say Sunday, yeah.
Okay, all right.
Yeah, that works.
Very good. Great. I'll 4:00-ish. All right. All right. I'll get a link up, and I'm going to record this too. But I would appreciate you all, those of you that can make it, come to this so that I can answer questions too. I think that's this interaction piece is going to be a really critical part to it. So let's go with Sunday at 4 p.m. and I'll just walk through. I'll put together an example and kind of walk through it, because what I'm envisioning you doing is having the 5 years of data that you'll already have gotten from Bloomberg, presumably, and then we're going to be projecting out. I believe I'm asking you to project out to 2025 here. So what you'll want to do is to link everything back to the data that you already have, and then we'll have some growth expectations coded in there. But I don't want to hard code growth rates. I want it to be flexible so that you've got a spreadsheet that if you decide your growth rate's going to be a little different, you can just pop that new number in and everything updates. The balance sheet balances, yada, yada, yada. So it gets a little bit complex on that. The other piece of this here is I scroll down that two other elements here that are really important and require a little bit of extra effort. Computing the growth rate. Now, I think in terms of mechanically getting the historical growth rate, I think you all are okay with that. Shouldn't be too big a deal. But I want to just point out that's just the beginning. That kind of gives you a benchmark, all right? And what I really want you to do and focus on predominantly is what's the growth rate going to look like going forward? And for that, you need those industry forecasts, economic forecasts, as well as some of the specific data that you know about the company itself, and where it's going, where its management thinks it's going. Do you think that management is accurate? Are they overly optimistic? Usually they are, but it's up to you to make that determination. And then factor all of that into a forward-looking growth rate. Remember, all of the analytical stuff that you've done is backward-looking. And you need that as a benchmark. But what's value added from what you're bringing to the table is, what do I think it's going to be like going forward? And then write up each of those factors. I think I'm asking you for 4 factors that influence the future growth rate. And then you'll want to write a brief paragraph on each of those. So that's another very important, potentially time-consuming aspect of this. And then the computing a required rate of return, probably the difficult part there is coming up with your own beta. You know, we can go to any number of sources, Bloomberg, Yahoo Finance, anywhere else you want to look on the web, and you're going to find beta estimates for sprouts. What I want you to do, part of this exercise, is you have to come up with your own beta estimate. And you know the CAPM, you've seen it already. We're going to talk a lot more about it right now, today, after we're done with this. But when it comes to actually implementing it in the real world, all of a sudden a lot of questions pop up. I've got a FAQ on the next page here that I don't have the assignment open, but if you go to the assignment, you'll see an FAQ about how to compute that beta. You're going to have to make some decisions, and again, this is the value added part that you as an analyst bring to the table. There are different periodicities, so frequency is a question. So do I use daily, weekly, monthly, quarterly, annual returns? And then what is the span? So this is a frequency versus span question. And the span is how many years do I use? What length of time do I use? Do I use 10 years? Do I use 15 years? Do I use 3 years or 5 years? And the way you make these decisions, again, requires some legwork on your part. You have to sit down and figure out, well, what sprouts look like today? And how far back in history did they still pretty much look like this company that I see today? And that's going to help you answer the span question. So if the company is very different today than it was 5 years ago, and 5 years ago is when that change occurred, then 5 years is going to be my span. But maybe they're the same company today as they were 10 years ago. then you could actually argue for making that span 10 years. The issue with span is twofold. One is it's related to the company itself. But the second piece of it is related to variations in the marketplace. If I make the span too short, I might only capture the movement of my firm vis-a-vis the market in an up market, or I might only capture it in a sideways market or a down market. What I want to do is capture the entire business cycle as much as possible while being sensitive to the fact that I want to make sure the company is more or less the same company over that entire span. My point here is I don't want the company's portfolio of assets to have changed in terms of their riskiness, right? So these are things to bounce around and talk to your teammates about and try to determine what's the span, what's the appropriate span for sprouts when I compute a beta. And then now the frequency question is a little easier. Typically, you're going to be able to find daily, weekly, monthly, and even quarterly data, price data. I mean, you get daily prices, and you can construct any of the longer frequencies that you want. That's pretty easy. Daily data gives you more observations. So if you have a 5-year span and daily data, 252 trading days per year times 5 years, that's over 1,000 observations. And more observations is usually a good thing. Oops, what's happening here? I lost my screen. Usually a good thing to have a lot of observations. The problem is that the higher the frequency, the less representative of a long run relation I have. So I could go minute by minute and have tens of thousands of observations, but is that really going to get me what I want? And the answer is no. So typically daily is a little bit too short in terms of frequency. So we can put that to the side. Usually we're going to be talking about weekly, monthly, or quarterly. And even in those cases, weekly, monthly, and quarterly, you could run all three of those with a particular company with the same span, the same market. And by the way, we use the S&P 500, and I think I've mentioned that in one of the facts. The ticker symbol is the Carhart, SPX. You could use the spider as well if you wanted, but the Carhart SPX is the actual index itself. It's not a ETF or anything like that. But that's going to be your index. Well, if you do weekly, monthly, and quarterly, I've done that exercise myself with various companies, and in some cases you'll get a positive beta in one case, nearly a zero in another, and a negative in another. And so what I would recommend that you do is look at multiple frequencies. Look at least two. So maybe you pick weekly and monthly, and you compute a beta on that basis. And you're going to have to use some judgment here. What's reasonable? Am I getting some weird result because of my choice of frequency? So, all three of these things, computing your expected rate of return, which means calculating a beta, getting your growth rate, and getting your pro forma financial statements put together, all three of those things are fairly complex, time-consuming tasks. My suggestion would be that maybe consider, each teammate, since most of the teams are three, there are 2 teams with 4, but most of you have a team of 3. Consider assigning each teammate one of those 3 tasks so that you can parallel work on this and not end up getting too close to the deadline and rushing this, because these are 3 very important tasks that will have a very significant influence on the outcome of the project. Okay, questions about any of this?
Can you just repeat that last part where you said how you would recommend dividing up the work?
Oh, sure. Yeah, just, out of the 3 tasks, so somebody who's particularly good with spreadsheets, you might want to pick them to do the pro formas. So that's this first thing, the pro forma financial statements. And then computing the growth rate would be another task. and then computing the required rate of return or the expected rate of return, and that is keyed in on you're going to have to compute your own beta. Now, and again, I would say, oh, yeah, Andrew, you had a question? Oh, maybe not. So, yeah, those are the three primary tasks that I would suggest you break it up that way, Brett. Does that answer your question?
Yeah.
Okay, all right.
Thank you.
One last thing about required rate of return. Once you have a beta, you also want to certainly look at how's your beta stack up against, say, what Yahoo has and what Bloomberg has, looking at reasonableness. Also, just think about the company itself. I mean, we don't have a high-risk company here, right? Relatively stable. So if you get a crazy beta like 3, you're going to go, something's amiss here. Either my data is wrong, maybe I'm picking a frequency that creates this weird outcome, or something's up. So not only give it that reasonableness test, but also compare it to other analysts' estimates. But I still want you to go through that exercise. I think that's very important that you understand where these things all come from. The second part of computing a required rate of return for the company is you also have to estimate what is the market risk premium and what is the risk-free rate. Now, it used to be, prior to the extraordinarily low interest rates that we've experienced for the last 6, 7, 8 years, it used to be that people would pick a T-bill rate as a proxy for the risk-free. Today, that's not as appropriate. Remember, these estimates that we're making go many years out into the future. And I don't expect interest rates to remain this low for many years out into the future. So you're going to have to come up with some sort of estimate of what is an appropriate risk-free rate. Now, could you use longer-term treasuries? Yeah, you could. And many people do choose to go that route. So maybe you pick a 10-year treasury or a 20-year treasury as your proxy for the risk-free rate. But again, I want you to think about this and think about the reasonableness of it. Maybe even go back 20 years or 30 years and look at where the T-bill rates have been. That's another way to approach that and pick some sort of average. Market risk premium, of course, there we also have variation, right? Market risk premium is the excess return on the market, which is the market return minus the risk-free rate. So the first thing, once you get your risk-free rate determined, then you also have to figure out, well, what's my market return? Do I take the average of the last 5 years? Well, maybe not. That's not a full market cycle. We've been in an up market. So I'd like to span the entire business cycle. So I'd like to see the market in an up stage, in a peak, in a down stage, and then down in a trough. I'd like to see that entire cycle. So you could possibly pick something like a 10 or a 15-year average. But again, I'd like you to go back and look at the market cycle and think about what is the appropriate time period, and then get your average, and then subtract your risk-free rate from that, and that gives you your market risk premium. And I'm doing too much talking and not keeping the iPad alive here. Sorry about that. Any other questions about this? Okay. Once you've got those tasks completed, then you're still going to have to compute a value. And we're going to do 3 different values. We're going to do the residual income model. And more than likely, you'll want to do some sort of 2-stage because we're in a weird period of time. And we're going to do a relative valuation using the PE. And again, you've got to you're going to use your comparables to calculate a PE that is appropriate to value Sprouts at. And then the final method is the kind of the no holds barred all-in DCF, right? This is kind of the gold standard, if you will. And that's what the pro forma financial statements are for, is so that once you get those pro formas done, you've got cash flows at the end of each of the years out into the future, those 5 years, or 4 years rather, and you'll be able to then calculate DCF. One last thing you'll have to come up with is a terminal value in year 2025, and then you just discount those back at your required rate of return. And then a final part of the step is your sensitivity analysis. All of these figures that we're estimating, the beta, the growth rate, the required rate of return, all of those things, and the cash flows on the DCF, all of those things are estimated with error. Ideally, I would use something like at-risk or Crystal Ball, which is a plug-in to Excel, and that would allow you to do some sort of very robust and rich sensitivity analysis. Barring that and the fact that we don't have that software available for you all, I just want you to come up with a base case and then a best and a worst case. Now, if you happen to already use at-risk or Crystal Ball and you've got a copy of it, absolutely use it. That would be fantastic, but that's not going to be a requirement. So let's get into Chapter 12. We before break, we wrapped up Chapter 11 and talked about an efficient frontier, looked at it with a 2-asset situation, and then we even added a third asset to it. The interesting thing about all of these efficient frontiers, and sorry about that, is that if we've got our here we have a measure of risk, usually with standard deviation. Here we have a measure of return. And here we have our efficient frontier, or rather we have our opportunity set. The efficient part of it is if we take a vertical line and kind of slide it over to the right where it touches, that is the minimum variance portfolio. And then so the rest of this is meaningless. We would never be down there because we would have, possibilities of having a higher return for the same level of risk than anywhere down below. So we're never in that part of the opportunity set below the minimum variance portfolio. So this piece of it is our efficient frontier. And what we're going to find is that many of our assets, when we plot them by themselves, they plot inside this frontier. And one of the things that, at least usually when you first see this, you think, well, gee, why would I ever hold that asset? It's an interior solution, and I can always either get a higher return by going here, or I can get a lower level of risk by going this direction or somewhere in between. So why would I ever own that security? And the answer lies in how that security is correlated with the other securities in our portfolio. Most securities are actually interior securities if held alone. It's when we hold them as a single portfolio that they're still what we call priced, meaning that they have a non-zero price, and they are still a valuable addition to the market portfolio. And they help us to get out to this frontier. And as we add things like international diversification, that pushes the efficient frontier further to the northwest. And the further we get this direction, we get some combination of lower return or lower risk or higher return. So anything that we can add to the portfolio that moves us in the northwest is useful and is a priced asset. Even if held alone, it's an interior asset. So keep that in mind as we're going through this. I'm going to reload this as well because for some reason it didn't load properly for me this last time. Let me try that again. All right. Yes, we got it this time. Great. All right. So a couple of details that we want to talk about, terms and information that we're going to see that's relevant here to the to the market model and to the CAPM. When we talk about news or announcements, you might be puzzled when you see a firm that has some sort of very positive earnings announcement, but the stock price reaction is negative. Or vice versa. Maybe you got a negative earnings announcement and the stock price reaction is positive. That has to do with what part of that information is new versus what part of it was already known by the market and was already incorporated into the price. So let's say, for example, that company XYZ had a negative earnings announcement. They were 10% below last year's. And the stock price reaction to that news was positive. Well, what we'd have to do is go back in time to the week before, when the estimates were that they were going to miss earnings by 15%. And by missing them only by 10%, that's a positive piece of news. That's a positive surprise. The market had already factored in a 15% miss, and now they're only going to have to factor in a 10% miss. So that's why you could see price go up on negative news, or what appears to be negative, and price go down on what appears to be positive news. It's all about how much of that news is a surprise. So we've got to be very careful about that because it's not a given that good earnings are always going to result in the price going up and bad earnings are always going to result in the price going down. And the same has to do with any other sort of firm announcement or market change. You've got to look for which piece of it is actually the surprise. Then a couple of other very important terms. We started talking about these actually before Easter break. But let me reiterate these things because they are so important and relevant to our discussion about the capital asset pricing model. So systematic risk, aka market risk, aka non-diversifiable risk. We've got all kinds of terms, all kinds of synonyms for this. They all mean the same thing. This is the risk that we are after. This is the risk that we're looking for, and the risk that we get paid an extra return for taking. This is business risk, effectively. The unsystematic piece of it, the unique risk, the firm-specific risk, the diversifiable risk, is the risk that we don't get paid for. It is not priced, quote unquote, and we should try to minimize that to whatever degree we can. And the easiest way to do that is by diversification. And that's why it's called diversifiable risk as well. That's why that's another synonym for this unsystematic risk. We can easily get rid of it by holding a diversified portfolio. By virtue of that, that means that's why it's not priced. If we can easily get rid of some risk, why should we receive any extra return for taking on that risk, right? So this gets us to the diversification. Don't put all your eggs in one basket. Some stocks will go up, some stocks will go down, and because of either positive or negative news, respectively, about their companies. Those are firm-specific events, and we are assuming that these events are i.i.d. I brought this up once before. Anybody remember what i.i.d. is? Independent and identically distributed. And I don't bring this up simply so that you have some sort of answer to a trivia question. I bring it up because it's unlikely that everything is i.i.d. in the real world. And to the extent that this is violated, then our diversification is not going to get rid of all the unsystematic risk. And that's a problem. Another piece of this is that these correlations change over time, and they change based upon whether the market is doing well or whether the market is crashing. Correlations, we know for a fact, or at least an empirical fact, I should say, we know that when markets have financial crises, that correlations go up. And that's exactly when we need those correlations, right? Is when we're in a financial crisis. So when the U.S. is having problems and our market is in a decline, we get better returns over in Europe or in Asia or in Australia. Well, fact of the matter is that there's usually some sort of contagion that goes on between the U.S. and these other parts of the world. And as a result, if our market's down, their market might start going down too. So we lose that normal benefit that in regular times we expect, because the U.S. could just be up a little and Europe's down a little, and they offset one another and we lower our risk. And that's all well and fine. It's when these catastrophic events occur that we really need that diversification benefit. And that's when these correlations all of a sudden just decide to change up and get out of here. So that's I bring up i.i.d. because not all things are i.i.d. and these things are not invariant across time. They do vary across time. And that's a problem for us as managers. Something that it may not be anything that you can particularly control, but you need to be aware of this when you're managing a portfolio. All right, so systematic risk is, and I mentioned this term before, and this gets used a lot in the industry. It's priced, meaning you get return for taking on this risk. You shouldn't get return for taking on unsystematic or idiosyncratic risk. You should only get return for taking on systematic risk, and that's said to be priced. Now, how do we figure out how much systematic risk a particular asset that we hold has? Well, this is when we start talking about that famous beta. The market beta is defined, not just equal, defined. That's why I put 3 horizontal lines there. That means defined as 1. It is always 1. Right? Now, individual security betas can vary all over the place. They can be less than 1, greater than 1, less than 0, even in some cases. So, more than 1 means that that particular security has more systematic risk held in a diversified portfolio than the market itself. A beta less than 1 means that that particular security held in a diversified portfolio has less systematic risk than the market itself. And thus, in the first case, we should get greater return. In the second case, we should get less return than our market risk premium. Here's some examples of how betas vary. So, if we just look at ExxonMobil and we go to MarketWatch, they get a 0.91. Yahoo gets a 0.68. Bloomberg probably gets something yet again that's different. You can see that these are non-trivial differences. Here's a huge one right here. IBM, 0.93 or 1.87. It's almost twice on Yahoo. And this is what I'm talking about, the question that I want you all to answer about span versus frequency when it comes to sprouts, is that, this is all a function of which span they chose to estimate betas and which frequency they chose to estimate these betas. So this gives you a good idea, a good picture of what's going on here. Look at Tesla, 1.32 versus 0.55. That's a pretty significant difference. If I'm doing some sort of valuation and I choose one over the other, that's going to change my answer by a lot. And I need to have some real confidence on which beta is the correct beta. There's only one correct beta. The question is which one is it? That's the tricky one. That's the tricky part. When we try to get a portfolio beta, our life actually gets a little bit simpler. A portfolio beta is the market value weighted linear combination of the individual security betas in that portfolio. It's the same way, in other words, it's the same equation we use to get the expected return of a portfolio. We just look at the market value weight as a percent. So if I have 50% of my investment in one stock and it has a beta of 1, and I have 50% of the other 50% in another stock and it has a beta of 1.5, then I simply get the weighted average. And my portfolio beta is 1.25. So in that regard, our life is a little simpler. And here's another example. So again, we're assuming 50% of our money is in Starbucks, 50% is in Nike, and with the two betas that we've already calculated, our portfolio beta is simply the weighted average of those two. Questions so far? All right, great. So now let's get into, we're headed towards this thing that gets called the security market line, the SML. Very important term that you know, and this is a very special line. And let's first off, let's look at security A. We have asset A. It has an expected return of 16% and a beta of 1.6. We're going to assume that the risk-free rate is 4%. And suppose that an investor puts 25% in the risky asset and 75% in the risk-free or the riskless asset. How do we calculate the return on that? Well, if we want to do this over a variety of weightings, if we put 0% in A, then the expected return is 4% and the portfolio beta is 0. If we increase our weighting on A to 25%, 3/4 of our money still goes into the risk-free. That bumps up our return, and it also bumps up our portfolio beta. Remember here, our risk-free rate, or our risk-free asset rather, has a beta of 0. And again, that is by definition. It has no risk, so it has to have a beta of 0. We don't get anything extra for there is no risk premium because there is no risk. Now, if we take this graph, we're just going to plot it here. And these spaces are important that you understand. We're plotting expected return on the Y, and we're plotting beta on the x-axis. And so here's our risk-free, and that was back here, that was this line right here. But if we go out a little bit, go to 25%, we've got 7% return. And what was it, 0.4% or 0.4 beta? And what you'll find is that these things all plot right on this line. And this would be 100% in the risky asset, in asset A. We can actually get out here by using margin. So we could borrow money and put that borrowed money plus our own money into the risky asset. And that would allow us to actually increase the level of risk and increase the return as well. All right? Make sense? So now we're looking at, and I have to apologize. I did not, hang on a second, let me grab my mouse. I didn't fix these equations. And this. All right. And down here, put parentheses here, a minus sign, and this is equal. All right. So there we go. So if we look at the return over the measure of risk, and our systematic risk is beta, then we are coming up with a 7.5% return for each unit of systematic risk. So remember, when we take these numbers, this 16 minus 4 equals 12, and divide it by 1.6, we get that 7.5. Don't forget, there's that implicit 1 in the denominator. So what this is saying, the 7.5% return for 1 beta unit of risk. So if I have 2 beta units of risk, I should get a 15% return. If I have half a beta unit of risk, I should get 3 3/4, and so on. So that's my reward to risk ratio. Very important element here. And what we're going to find is that for all securities that are priced, the reward to risk ratio should be the same. All right. Now, let's add another asset here. We've got asset B, which has a 12% return and a beta of 1.2. So which investment is better, A or B? Asset A has a higher expected return at 16%. Asset B has a lower systematic risk at 1.2 versus 1.6. And if we were to plot asset B on here relative to the risk-free rate, we would get this, but the graph is a lot easier to see. So why don't we just look at that? So here is 0% in the risky asset, 100% in the risk-free. This would be 50-50, and this would be 100% in the risky asset. And then out here would be a margined investment. Now, when we do that same calculation, we take the 12% minus the 4 all over 1.2. So in essence, we're just scaling it to a 1. We get 6.67% reward for each unit of beta risk that we take on. Clearly, that tells me right now, I want asset A. Asset B is giving me less reward per unit of risk. But there's a dynamic going on here, right? Because everybody's going to overlook asset B because it's giving me less reward per unit of risk. And everybody wants asset A. So the price of asset A is going to be bid up, and the price of asset B is going to be bid down through supply and demand effects, right? Now, how does that change their reward to risk ratio? And here's a little trick that kind of a shorthand way of thinking about this, because when you think about, hey, a price is being bid up, how does that give me less return? And if the price gets bid down, how does that give me more return on that security? And the answer is, let me change from the real world into a very simplified world. Let's go to a one-period world. So I begin at time 0, and the world ends at time 1. I buy something here, and then I find out what it sells for or what its value is out here. And I'm going to assume that its value is $1. Now, it's a risky asset, so I'm supposed to get some sort, and it has systematic risk. I'm holding it in the context of a portfolio, yada, yada, all the good stuff. So obviously I need to get some return for this. So if my risk-free rate is, say, let's use that 4%, then if the security is priced at, and I'm going to forego the fact that there's a multiplication effect going on here. Bear with me. I know that 4 cents of 96 is more than 4%. You get that? but just for expositional purposes, let's assume that it's not. So let's say that we are able to buy the risk-free for 96 cents, and we get a certain return of $1 at the end of the world. That's approximately, so let me put that, approximately 4%. It's a little more, I know, but you get the idea. So if I have a risky asset in this world, then I want more than the risk-free rate. So it's selling at a price of 90 cents. And on average, at the end of the world, it's going to give me $1. Now, that's not a guarantee. Each iteration of this one period world, we're going to get, sometimes we'll get more than $1, sometimes we'll get less than $1, but on average, we get about $1. Whereas the risk-free, we always get $1, no matter which version of the one period world we're in. Remember, we've got these parallel universes as well. So that gives me, and again, if I'm getting a 10 cent return out of that, that's a little more than 10%. Because it's 10 cents on 90, not 10 cents on a full $1. So my percent return is a little greater than 10%. All right. Now, how do I make that risky asset yield less? Well, if the price was 91 cents, I'd only get I'd only get 9 cents or $0.09 out of it. So as price goes up, my return decreases. So if you think about it in this context, bidding up the price of A, bidding up the value of A, actually reduces its return. Bidding down the value of B actually increases its return. So if you think about it in this very stylized, very hypothetical one-period world, that's how it can make sense, okay? So everybody's after asset A, nobody wants asset B, and eventually we're going to come to some equilibrium where the reward-to-risk ratio for A is equal to the reward-to-risk ratio for B. Even though they may have different risks, they still have different systematic risks, but that ratio between reward and risk becomes the same. And that's what's going on with thousands and thousands of these securities. That's why this reward-to-risk ratio always has to be the same for all securities. If it isn't, we have that, if we have security C here, which is getting too much return, it should be down here. Its price is going to get bid up, which is going to lower its return. It's going to drive it back down to that line. And security D here is getting too little return. It's going to be bid down, and that's going to move D back up to this line. A and B are already on this line. And really, this line is what we call the security market line. I'm going to skip over the math there because we've really already talked about it. That is the result, is that the market is there and all the securities, all the thousands of securities with different betas all have the same reward to risk. They have different risk. They have different systematic risk. Their betas may be very different from one another. But in the context of a diversified portfolio, they all yield the same ratio of reward to risk. And right down here, voila, out pops the capital asset pricing model. Now, we've been waving our hands over a whole lot of heavy-duty calculus. Believe me, I took an asset pricing class the first year of my PhD program. It will make your head spin. It will cause you to look as sparse on the top of your head as I am, but when you're pulling your hair out, dealing with all of this calculus and Diffie-Q stuff, there's a lot more behind this, believe me. So this is the simplified version of it all. But this is where CAPM really, this is kind of the foundational stuff. This is the really important pieces of it. There's a whole lot behind it, though, that if you want to get into that, I can recommend some books if you're interested in that sort of thing. The work still goes on. Now, how do I calculate my beta? You can use the regression plugin in Excel, or you can actually use some of the functions in Excel, because beta is also equal to the correlation times the standard deviation of the security divided by the standard deviation of the market. It is also equal to the covariance between the market and the security divided by the variance on the market. So that's another way to get to it. In fact, that's the more typical way, covariance between x and y divided by the variance of x. So you don't have to run a regression. Now, the benefit of running a regression is that the output from that regression, I think here I thought I had a slide. I don't have a slide on that. The output from the regression actually gives you more information. It gives you an R-squared. It gives you some t-stats. Gives you some p-values. Hopefully all of this is sort of ringing a bell. You know, shades of Dr. Welke's EC 210 class, right? So those are important things to look at as well. And by the way, kind of a jump back to the discussion at the beginning of class about coming up with a beta. When you run that regression, you might find that you get an R-squared that's very low. And by very low, I mean something well under 0.5. Remember, R-squared goes between 0 and 1, or 0 and 100%, you can think of it. So if X completely defines and completely captures the variation in Y, then you would have an R-squared of 100%. If X has no relation whatsoever to Y, you would have 0. And obviously anything in between. So if X captures 10% of the variation in Y, your R-squared is 0.1. You're going to find some R-squareds that are pretty low on your regressions. I'm telling you that from the get-go. That's just experience. You're also going to find some t-stats that are very low and p-values that are very high, relatively speaking. Now, p-value is telling you how significant your coefficient is. And remember, we're calculating a beta here. So we're looking at the p-value on beta. The higher that p-value is, the less confident I am that I've actually got the correct beta. So high p-values, low t-stats, and low R-squareds are all signs that you don't have a very good relation between your x and your y variables here. Now, there may be nothing you can do about it, but that's part of your task as an analyst when you're calculating beta, is to look at all of these things and make a judgment call. Now, if you get lucky and you have an R-squared of 0.5, that's really good, actually. If I get an R-squared that's really close to 1, I think I've done something wrong, because that usually means there's a unit root somewhere and I've done the calculation wrong. So be careful of that, too. It can give you a false sense of security. One last comment, too. When we're doing these calculations, remember, this is not a calculation or a regression where we're regressing price on price. We're regressing return on return. So the data you get out of Yahoo or the data you get out of Bloomberg is going to be price data more than likely. You're going to have to create that, turn that into a return before you can do anything with it. All right, I'm going to skip over this. You can look back at this. So this just gives you an example of how you can calculate the variances, the standard deviations, the covariance, and then calculate your beta from those figures. So beta is covariance over the variance of the X variable, or in our case, the market, or it's the correlation between the two times the standard deviation on the security divided by the standard deviation on the market. Let's see here. I talked about that already. This really just gives you an example of fitting that line, right? Here is our regression line. This red line is our regression line. We're fitting it to the data. So we're finding what's OLS stand for? Ordinary least squares, right? So what we're doing is we're finding the line that gives me the least difference when I take the difference from each of these actual observations to the line and square it and then add them up. It's the line that gives me the least variation. So what I might do is I might tilt this line a little bit. If I tilted this line this way, I would get, less variation here, but more here, about the same with this one and more here. So this one can't be the line. So I could actually do this kind of by hunt and peck. I could tilt my line a little bit this way, a little bit that way, and then calculate the least squares. Obviously, we've got a computer that does that for us, but that's what that line is. That is how we end up with this particular line. And actually, by the way, just FYI, the line always goes through X bar, Y bar. So the average of X and the average of Y is always on that line. And then basically we're just tilting it to find that the particular slope on that line that gives us the least variation to the real data, to the observations that we have. I thought I had this slide in here. So here's the extra information we're getting out of this. We always want to use our adjusted R squared. Everybody remember what the adjustment is for? Dr. Welke would be very proud if anybody could answer the question, I know. Any ideas? By construction, when I add additional explanatory variables to my regression, I'm going to increase the R squared. I won't go into the math behind that, but just trust me. So what this adjusted R squared says is, hey, I know that's going to happen, even if the things I add, I have no relation. So I might add number of sunny days in Cleveland to the regression. That's going to bump my R squared up. It's going to look like I get a better relation, when in fact there's zero correlation between the number of sunny days in Cleveland and return on sprouts. So this adjustment is the number we're looking at. We don't really care what the R squared itself is. That's irrelevant. We're explaining about a third of the variation in Y by our X variable in this case. That's not bad, actually. That's pretty decent, really. I've seen a lot of them that are well under 10%. Okay, the other things here, t-stats, p-values, those are important. In our case, we're only running one X variable in this model. And of course, that is the market return. We get a coefficient of 0.9, so our beta is 0.9. Just slightly less systematic risk than in the market itself. What does the t-stat tell us and the p-value? Well, the t-stat tells us that it looks like it's marginally significant. It's not horrible. P-value is that 17% of the time we're getting something that looks like it's significant, and in fact it really isn't. The actual value of beta does not fall within a range around this value that we're estimating. 17% of the time. It's a lot. I wouldn't want to, take any great risks on that basis. I'd like this p-value to be at least no more than 0.05. And that's a typical p-value that we use. Better yet, if I were down at 0.01, I'd feel a lot more confident that 99% of the time, the range around this standard deviation or 2 standard deviations around this is going to capture the actual beta, the population beta. And remember, the reason that that matters is that right here, I've only got a sample. And in this case, I've got a sample of 5. Now, obviously, there's no way that 5 is a real sample that we can put any confidence on. And that's not too surprising that we get a p-value of 17% here. It is a little surprising that we get such a high R squared. All right. So that's the information that you're going to pull out of here when you calculate your beta. And it may be that any way you run this, you don't get much of a relation. You don't get much confidence in it. And then, so when you do your sensitivity analysis, what you do is you put very wide ranges on your estimate of the expected return. If you get a very high R squared and you get a very low p-value, then you have more confidence about your estimate and you narrow the range. Think back to when we did that little exercise in Chapter 8. We're looking at behavioral finance and we're estimating the weight of a adult blue whale or something like that. And you guys came up with ranges. That's the whole idea. If you had no clue, you would make your range wider. And if you were fairly confident, then you make your range narrower. Already really talked about why betas vary from one another, so I'll skip over this slide. Extending the CAPM. Okay. CAPM it was developed, it began back in the 50s, and it's still up for debate. Back in the latter century, in the 20th century, there was a point in time when most academics would have said beta is dead, and they just walked away from beta. Now, beta's back. We still think that beta has some value. We're adding to the valuation models. So one of the most famous is from 1993, and that was the Fama-French 3-factor model. Eugene Fama and Ken French came up with this, 2 of the most prolific authors in the entire profession of finance. And they said, you know what? Beta is great, but we also see some sort of size effect, and we see some sort of book-to-market value effect. So what we're going to do is we're going to add 2 more factors. And we're going to call this one SMB, that's small minus big. And we're going to call this one HML, and that's high minus low. And these 2 factors actually add to the estimate. It helps increase our R squared in that regression. So if we go back here to this regression, I'll clear off the mess I made. If we go back here, what we'll do is we'll have the small minus big, we'll have the high minus low, we'll get some sort of beta here. Maybe it's 1.2, maybe this one is 0.3, and we'll also get p-values and t-stats and so forth. And what we would find is maybe the R squared goes up to 0.52 or 52%. So it increases the ability to predict the variation in Y using our explanatory variables X. So we've added 2 more explanatory variables to the model. So now, and each of these, remember, is called a beta, even though the beta, the one that everybody refers to in the profession, is still this one. We could actually refer to that as beta 1. This would be beta 2. This would be beta 3. Just by the way, regressions are done. All the right-hand coefficients have a beta on it, right? The intercept is alpha, and the coefficients on the x variables are always beta. But this one has that very special definition of being the beta. Sort of like the OSU, right? Okay, so Fama and French came up with additional factors. And this just shows you how these portfolio returns vary on the basis of book to market and also on size. And you see quite a bit of variation. The lowest book to market, smallest cap stocks have 9.23. And if we go over to the other extreme, large cap, high book to market have almost 15% return. So that's a pretty wide spread. That's why these factors were added to the model. So now we have 3 betas. And if we go a few more years into the future, from the Fama-French 3-factor, we have the Carhart 4-factor model. And then Fama and French came back in 2018 and said, wait a minute, we've got a couple more factors we could add to this. So we've got the Fama-French 6-factor model. And then Hugh et al. Came up with a Q to the 5th model, which is a variation on his Q5 model. And his evidence is pretty strong that his factors are more relevant than the Fama-French factors. At least that's what his empirical research shows. So remember, the point of this picture here, it's all just a model. It's a representation of the real world. What actually is going on in the real world, we still don't know. We're still exploring it. So as analysts, some of this stuff, especially these newer models, are probably not well known by the profession. So this could give you all an opportunity to kind of get a jump on the profession as a whole. Now, don't get me wrong. There are PhD quants that are working on this right now. But your average finance professional may not be aware of this sort of thing. So, if you have the interest, if you're kind of in this mode of asset pricing, think about getting this paper or getting this. I've got the link to the Hugh et al. Paper right here. You can go straight there. Now, these papers are pretty dense. They're pretty technical. But browse through the intro, browse through the conclusion. Don't worry too much about the math behind it. And see if you can make some sense of that, because who knows, that could be an opportunity that you may have one of the first models using some of this more current research. You may get a leg up on your fellow analysts. Let me go back to one last thing that I skipped over here earlier, and that is these extra pieces are not really in the text. So, but I did want you to be aware of the critical assumptions that underlie the capital asset pricing model. And, remembering back to Chapter 8, how we said that we use this rational economic man. And so the rationality assumption is part of CAPM. It also assumes a broadly diversified range of investments in our portfolio. It assumes price takers. What's a price taker? A price taker is someone who cannot influence price. I accept the price for what it is in the market. In other words, we are all what we call atomistic investors. We don't move markets. We're small. To the extent that we have big players in the world and they can move markets, that's a violation of the assumptions underlying this model, and that means that then the model starts to fall apart. We can lend and borrow unlimited amounts. Not very realistic. That's usually not the case. We can trade without transaction or taxation costs. Again, not very realistic. We all have homogeneous expectations. So my expectations are the same as yours, they're the same as everybody else's. Well, that's not true in the real world. And we assume that all information is available to all investors and incorporated into their updated valuations all at the same time. Again, of course, that's not true. So we have to be very careful about these models. We have to make sure we're looking at some of the more current research and not just assuming, hey, I just calculate beta and I got it. No, you don't. You may be very wrong. Maybe I need to do a 3-factor. Maybe I need to do a 6-factor. Maybe I need to use Hugh et al.'s Q5, Q to the 5th model. And to what degree do violations of these assumptions cause my model to break down and give me faulty predictions? Now, some of these assumptions have been relaxed in more recent research, and we can say, hey, it doesn't matter too much about the rationality assumption as long as I have substantial amounts of arbitrage going on. So we don't have to worry about that one. But some of these are pretty important. Price takers, transaction costs, taxes. I can't just forget about that stuff. Let's see. I think that kind of brings us to a close on Chapter 12 and CAPM in general. Any questions that came up as we went through this? All right. I've got to get in. I think I'm missing a homework assignment. I'm going to get that posted today. That'll be due next Monday. So keep an eye out for that. You've got a reading assignment, though. I know that's already up there. And if there are no more questions, I will see some of you on Sunday at 4 p.m. I'll set that up and send that out as an announcement, and we'll go over how to develop the spreadsheet for the pro formas. And as always, with the other stuff, with the growth rate and with the beta estimates, I don't think those are quite as difficult, but certainly if you have questions, please make sure that you email me. We can either communicate via email if it's a relatively simple question, or we can set up a specific Zoom or a phone call or something of that nature. Otherwise, have a great weekend. I'll see you all next Tuesday. Bye-bye.
Thank you. Have a good one.
Thank you. Bye.